sending any signals that we need to rush into rate cuts, the Fed Reserve Chairman stated yesterday. The sentiment was echoed by the other Fed policymakers who also spoke at the various events yesterday. For instance, Susan Collins of the Boston Fed Reserve similarly noted that there is no great urgency in cutting rates, emphasizing that the primary goal of policy decisions should be to maintain a healthy economy. Notably, currencies have been trading primarily under the influence of political news for over a month. Economic indicators have taken the backseat, and this is evident now as the dollar's reaction to mostly hawkish signals from the Fed Reserve turned out to be notably distorted. On a Wednesday, its price on the six currency index even tested a weekly low, consolidating within the daily range of 106.10 to 106.50. It's not because geopolitical fears eased following a speech by Russia's foreign minister. The market simply needed a pause to catch its breath after the feverish Trump-driven rally that pushed the US dollar index to nearly 107 points. Moreover, the sheer number of pledges made by Trump makes it challenging to track their fulfillment. Additionally, the market is already facing difficulties due to his contradictory appointments for ministerial positions in the future government. Some of the proposed candidates have limited experience in the fields they are set to oversee. In this environment, analysts advise traders to pay close attention to reliable economic data, especially when developing medium and long-term strategies. For those who integrate published statistics into their work, we regularly release a trader's calendar. However, in the face of media reports, economic releases may be temporarily overlooked by the markets, as was the case yesterday with the Eurozone inflation data. Interestingly, this topic was revised today by the European Central Bank, which published its wage growth indicator. According to the report, wage growth in the third quarter accelerated by 5.42% year-on-year. Higher wages support the case for rising inflation, which in turn could lead to less aggressive cuts in the ECB's refinancing rate. However, the sudden increase in the annual CPI has provided no support for the euro so far. The euro today hovered near intraday lows around 1.0550 against the US dollar. The bulls might still attempt to push the euro above the technical resistance level of 1.0608 during the consolidation of the overbought dollar. In this scenario plays out, the correction could extend to the trend channel border at the 1.0664. However, the most likely outcome remains rather euro selling, which would first bring the price toward the technical support level of 1.0557. In the case of a breakdown, the euro-dollar pair could hit toward 1.0496. For now, the consolidation seen over the past 24 hours may turn into a sort of a stagnation, as the economic calendar for the second half of this week is nearly empty. The market boost may pick up only on a Friday with the release of preliminary estimates for business activity indexes. Notably, the Eurozone figures are expected to show growth across all three metrics: manufacturing, services, and the composite index. The composite business activity index is anticipated to rise to 50.3 points. At the same time, the composite PMI for Germany looks much worse, hovering around 48.6. The forecasted GDP growth for the Eurozone's leading economy is even more alarming. Germany's annual GDP rate is expected to decline by minus 0.2% from a year ago. Thus, any uptick in the euro's chart if it's occur, is likely to work against the single currency rather than in its favor. Interestingly, oil prices are currently behaving much like the euro, essentially ignoring economic data. For instance, the American Petroleum Institute's report showed a significant increase in the U.S. oil inventories. Instead of the expected 0.8 million barrels, crude stocks rose by 4.8 million barrels. However, oil traders showed a little reaction to this report. The Brent price, for example, remained on an uptrend within the daily range of $73.10 to $73.90 per barrel. Could the data from the U.S. Department of Energy attract more market attention than the morning reports? Especially since the figures, according to forecast, are also expected to show a crude inventory increase of 0.8 million barrels. If the actual figures exceed the forecast, the decline in oil prices might still be on the horizon. The Russian market has also fallen victim to political news. Just yesterday, stock prices plummeted intraday, with the losses reaching around 3%. The sell-off affected all sectors from Sberbank, Gazprom, and Rosneft to Yandex. The official US dollar exchange rate set by the central bank for November 20 is now above 100 rubles. At the same time, the situation remains highly tense, keeping the ruble under continued pressure. Currently, the combination of factors rules out any possibility of the Russian currency strengthening. On the contrary, the odds are for further weakness, and this situation is likely to persist for several more days, or possibly until the start of the next trading week. So how is trading going to unfold in the short term? We will definitely tell you in our next video reviews. Don't miss them and stay up to date with the latest market news. Subscribe to our channel and see you! Former US Treasury Secretary John Connolly once said, "The dollar is our currency, but your problem."